Welcome back, everyone. Thank you so much for being here. Thank you for joining. If you're new, please make sure that you are subscribed to World Affairs in Context on Substack or Patreon for more and exclusive content. I would absolutely love to see you there. Just follow the links in the video description below to get connected. It just takes a second. For months now, the official story that we heard in Washington has been that the United States economy is holding up just fine. In fact, we hear that the U.S. economy is the strongest it's ever been.
When you'll see numbers like nobody's ever seen before. The economy is doing amazingly well. I wish the press would report it, but people are finding out. They're seeing it. It's coming. It's becoming pretty evident. It's hard to hide.
Consumers are resilient, they tell you jobs are plentiful and growth may be slowing, but there is no real reason for you to worry. And yet, when you look at the data, which we're about to do in this video, it tells a very different story. What you notice when you look at the details is rising financial stress, growing uncertainty, and an economy that's very clearly losing momentum. It is losing steam. So let's start with the consumer, the backbone of the US economy, because that's where the cracks are becoming impossible to ignore. On Friday, February the 6th, Federal Reserve data showed that in December, US consumer borrowing surged by the most in over a year. In other words, Americans are maxing out their credit cards, they're maxing out their lines of credit just to make ends meet. That's it. That's what's happening. And that's a very sad reality that we're living in. Fed data showed that the total consumer credit outstanding jumped by $24 billion, which is a massive acceleration from the modest $4.7 billion increase the months before. So we're talking about month-over-month fluctuation, $24 billion added in consumer credit. This was not, of course, just higher than expected. It actually blew past every single estimate, every single forecast. And importantly, this wasn't driven by one-off spending. Both revolving and non-revolving credit rose sharply at the same time. This is not a coincidence. It's very important to note here that these numbers do not include mortgages, so no long-term borrowing is included in these numbers. Non-revolving credit, so things like auto loans and student loans, increased by just over $10 billion. This is the biggest rise in 7 months. That alone should raise eyebrows. But the real red flag, as if that wasn't enough, the real red flag is what happened with revolving credit. Credit card balances jumped nearly $14 billion in a single month, the largest monthly increase in more than 2 years. Remember, this data doesn't include mortgages. This is day-to-day living financed at interest rates north of 20%. Is this sustainable? Absolutely not. This cannot go on for a long time. Someone has to pay back this debt. And unlike the US government, Americans are on the hook for their credit card balances. They must pay back their borrowing. And if they don't, what happens? What happens? Defaults rise, right? So, and I hate to be pessimistic here, but I do expect to see a rise in defaults later this year. Why do I expect that? Well, I actually have bad news for you, and I discussed this in great detail in my video that I uploaded yesterday. The labor market is crashing. January showed a 205% increase in US layoffs compared to December. Month over month, a 205% increase in layoffs. Just think about that. And we will get to that in just a moment. So maxing out credit cards is not the behavior of a confident consumer. It is the behavior of households that are effectively filling the gap between stagnant income and rising costs with debt. That's what's happening. And that's where the timing becomes critical, in my opinion, because this explosion in borrowing is happening just as the labor market is starting to weaken considerably. In January, US employers announced 108,435 layoffs. That's not a typo, that's not an error. Layoff announcements were up more than 200% from December, from a month prior, and 118% increase compared to January a year earlier. Even more striking, this was the highest number of job cuts announced in any January since 2009, right in the depth of the Great Recession. Now, layoffs do tend to cluster early in the year, it is true, and you may say, well, it's January. That's not that unusual. This happens because companies clean house, they restructure, they reset their budgets, and that is normal. But this January was not normal, not even close, and here's why. According to Challenger Gray & Christmas, the firm that tracks this data, most of these layoff plans were finalized at the end of last year. That means companies entered 2026 already expecting weaker growth, softer demand, and tighter margins. So in other words, corporate pessimism didn't suddenly appear this month or in January. It was baked in months ago. And here's where things get truly concerning in my personal view. At the same time that layoffs surged, hiring intentions collapsed. In January, companies announced plans to hire just over 5,300 workers nationwide. No, this wasn't just in one city or in one state. 5,300 workers nationwide. This is the lowest number ever recorded for the month since Challenger Gray & Christmas began tracking hiring plans in 2009. This was lower than during COVID, lower than during past recessions, so absolutely unprecedented. When layoffs rise and hiring plans dry up simultaneously as they do now, that is not routine belt tightening. That's not just cutting costs. That is a warning signal. There's more to come, and it will be worse. What's worse is that inflation is expected to rise this year. So some would argue that it might begin to look a lot like stagnation. This fits into a broader pattern that's been developing for more than a year, the so-called low-hire, low-fire labor market. Layoffs haven't exploded across every single sector, you may have noticed this, but hiring has slowed to a crawl. Job openings have been drifting lower and lower every single month. Workers are finding fewer opportunities to switch jobs, to negotiate better pay, to negotiate higher pay, or to climb that corporate ladder. There are just fewer opportunities for them. And so stagnation is brutal for households. Economists often describe job openings as a forward-looking indicator, and that's why it's such an important thing to keep in mind. Job openings tell you what employers plan to do in the near future, not what they've already done. And so when openings decline, it's a signal of hesitation, and it signals uncertainty. It signals that businesses don't trust the future enough to commit to hiring individuals, to commit to growth. They're not looking to expand, they're just looking to survive, in other words. And so that uncertainty is everywhere right now, and I'm sure many of you can relate. Let me know in the comments below what you see in your areas, what you see in your state. I would love to hear from you. So consumers are borrowing more, and not because they're optimistic, but because they're trying to maintain their standard of living. Credit cards are becoming a substitute for wage growth. At the same time, companies are freezing hiring, they're cutting costs, and they are preparing for leaner times ahead. This is preparation. And so this combination is especially dangerous. Rising consumer debt can temporarily prop up spending, and that's where you see, while consumer demand is strong, but it comes at a cost. As interest expenses climb, households have less room to maneuver. And any shock, such as a job loss, reduced hours, maybe a medical bill, those things can quickly turn manageable debt into a complete crisis. And remember, these layoffs are announcements, not yet reflected fully in the official unemployment rate. That's why the surface data still looks okay, and so Washington is able to manipulate it enough to tell you that everything is good, but the real damage often shows up with a lag. This is how an economic downturn begins, not with a dramatic collapse, but with very subtle shifts, and we certainly see many of those subtle shifts right now. We see fewer job openings, fewer hires, more reliance on debt, more anxiety behind the scenes. The narrative we are being sold is that the economy is resilient, but resilience financed by credit cards and met with corporate pessimism is not strength, it is fragility. It's extreme vulnerability. The key takeaway here is simple but extremely uncomfortable, and I'm sorry to say this. Consumers are stretching, companies are retreating, and the labor market is losing its forward momentum. That's not a recipe for sustained growth. This is a warning that the foundation is weakening, is cracking, even if the headline numbers haven't caught up just yet. And once confidence breaks, once layoffs move from announcements to reality, and once debt stops bridging that gap for households, the adjustment can happen very, very quickly. And of course, here I'm talking about those defaults. This is the moment to pay attention, not to the optimism in press releases or White House statements, but to the signals that are underneath, because they're telling us something very, very important. And I hate to admit, this is not good news. If you would like to learn more details on the surging layoffs and the crashing labor market in the United States, I just uploaded a video on that yesterday. You're welcome to watch it next. Thank you very much for watching. I appreciate your time and thank you so much for being here. Please support my work if you can. Become a paid subscriber on Substack, Patreon, or YouTube. I appreciate every single one of you who has become a paid subscriber. Thank you so much. I hope you enjoy the rest of your day and I will see you back here tomorrow. Bye for now.